Some of you have smaller accounts, and so there's a big problem in that you might find it difficult to take trades home overnight because the margin increases. This obviously is a problem because your account's underfunded and you have big money problems. The biggest problem is you don't have the money. So what can you do as a I don't want to say as a hedge, but instead of coping and having to day trade or scalp, which might not be suitable for you for a whole bunch of reasons. One, you don't have the tactical skill. Worse, you don't have a good sense of timing, so it's never going to work for you. There is a way that you can take risk home overnight by using spreads. Again, you'll have to figure out what's appropriate for you. Talk to your financial advisor. I can't give you trading advice proper because I don't know you. But if you took a look at some spreads, there's ways to manage your risk by being simultaneously long short. By doing that, you cut your risk substantially. In this case, we're looking at a spread between NVIDIA and AMD. And in this case, you'd have to have the account set up to be able to short sell stocks. With stocks being short, you have unlimited loss potential. You mitigate that by position sizing. This spread takes a look at what would happen if you bought NVIDIA and sold another chip maker against it. And you can see that the spread had been down to $120, which meant the price of AMD was higher, right? Because whenever you multiply something, a bigger number from a smaller number, you're going to get a negative balance. But you can see that the spread here is widening. Whenever it gets bigger, it's widening. So at the end of the day, it's moved quite something. Right here is March, and here is June. So in 3 months, if you felt the volatility of any one particular name was too strong for you, you could trade both very much smaller and traded the spread, right? Then you could see that it's narrowed from 20 to where it is now at 52. As who knows, maybe it starts to reverse, but you can see that there's breakouts, there's pullbacks. You can look at this and say this might be more appropriate for you or better for you for your tolerance of risk. I don't know, talk to your financial advisor. But you can see the spreads actually move. Maybe this thing is going to get to par where the share prices are equal and then become positive where the share price of NVIDIA exceeds that of AMD. Now, you can also replicate this with options, but they do expire and you need to have the money where you can buy, a call on NVIDIA and buy a put on AMD. If you wanted to play it that way, that's a little bit more moving parts, so I'm not going to cover that here. But for those of you that trade futures, you can look at term structure, right? So here we're looking at crude, and you can see that the market's inverted. So the front months are higher in price than the successive months. When the market is in a normal market, the successive months are higher priced, and the difference between those prices are known as carry charges. The carry from one month to the next in term structure is, can be calculated. Those values are known. They don't typically trade to what we call full carry. You'll probably get between low end 60 to maybe 90% of full carry. So they don't really trade to their theoretic full carry values, even when markets are normal, right? So then what happens is if the market is tight or there's higher demand, markets can invert. And that means the front months have higher prices than the successive months. And you can see that here in crude oil. It also says that if you bring whatever you have to the market, because we'll insure it for higher prices, we're actually going to penalize you if you choose to deliver in October. So this instigates people to bring their inventory to market sooner because the prices are better than if they were to defer them. And if you look how far we can go out, you can go out to next year and you could see that it's substantially lower. Now, there is no upper boundary. Where there is a full carry in a normal market between months, there is no upper boundary when you look at what happens when markets invert. To say it in English, this could go to 90, 95, 100 while this stays still, right? So this provides an opportunity for you to buy a front month and to sell a deferred month against it and play that spread widening. So I took it upon myself to create another spread using October, December, which is a very liquid spread, no pun intended. October, December is a very active spread, and you can see likewise the spread has widened. In October, was trading at went from a 40 cent premium to a $1.80 premium in a very short period of time, right? So that's December 13th of last year, and this is April 5th. So it's not like it doesn't have pullbacks, but this is a case where you would buy the October and you would sell December against it. The point being is that when you're on both sides of the market, you're afforded lower margin. So that might help some of you who have smaller accounts and you can't take directional trades home overnight because they increase the margin on you. In my experience, you'll have to clear it and see what your clearing member does for you. But normally, if you're trading intra-commodity spreads, which is what this would be, you might be afforded anywhere between a 70 to a 90% discount on the outright directional margin because you're simultaneously long and short two highly correlated instruments in that crude is highly correlated to crude. Now you can see that there's chart patterns here. You get little head and shoulders perhaps. You sell it off, you bottom, reversals. You can trade breakouts, the same difference. And so now it's like, how high can it go? How high can October go above December? Because even if they both go up, as long as October accelerates, you're going to make money. If December collapses more than October, net, you're going to make money. So this is just something to investigate. You might find that it's helpful for you. Again, you'll have to figure out what's appropriate for your cash and your account and your tolerance for risk. I can't give you financial advice, so you can't hold me accountable here. You'll have to figure out what's appropriate for you. But people asked on the when we talked about margin and taking positions home overnight, you can do it with options. You could trade positions smaller. And if the micros are still too big for you, you might want to just consider stopping until you can raise enough money to put it into your account so you could do this the right way and not have to kind of fit something that might not even be congruent with who you are or what you're trying to do, and use that as an overlay. It's hard to make money in those situations because now you're really coping. You're not really becoming who you are. You think you are because you're doing trading, but at the end of the day, you have so many handcuffs you can't possibly succeed. I haven't seen it. Anyway, take a look at spreads. They're very reliable. They're seasonal, so you can count on them in the commodities markets where stocks are secular, commodities are cyclical, and so you might find some value in that, to help you along in your journey. Check out these videos here.